assessment of the fundamental presumptions that support the 2025 budget, such as predicted revenues and benchmarks for oil prices. The move aims to mitigate the impact on the country's $6 billion annual export to the U.S., which would worsen economic challenges such as inflation and a weakened naira. We're speaking during the inaugural Corporate Governance Forum organized by the Ministry of Finance Incorporated in Abuja. Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, assured that Nigeria's economic management team, which includes important players from the public and commercial sectors, will carefully examine the changing circumstances and suggest the best course of action to reduce risk and adjust to changes in international commerce. Well, joining me from our Abuja studio to talk more on this is the Director of the Institute of Capital Market Studies in Nasarawa State University, KEFI President of the Capital Market Academics of Nigeria, Professor Uche Uwaleke. It's good to have you join us on the show.
Thanks so much, Sarah. My pleasure being here.
It's always a pleasure to have you on the show. Of course, let's start with what we have, the present stats that we have of Nigeria's debt profile, external and domestic, and in total figure, it's getting scary. In your understanding, what do you think? How did we get here?
Well, I think you rightly captured it when you said it's getting scary. 144 trillion naira. Scary in the sense that if you look at the trajectory since 2014, the pace of debt accumulation, is worrisome, to say the least. In 2014, December, between 2014 and December and December of 2024, the latest figure we'll have from the Debt Management Office, total debts increased by over 1,000%. And if you look at the external components, by over 4,000%. So the pace is a source of worry. And of course, for the domestic components, we also understand why that has been so. I recall not too long ago, the CBN Ways and Means, contributed to it because the total 27 trillion at the time of CBN Ways and Means, was securitized. And of course, we began to see that being reported in public debt figure. So the debt stock has grown astronomically. It's important to point out, however, that it's not the size really that is the worrisome aspect of it, because debt to GDP ratio is still within international threshold. Debt to GDP ratio is still below 56%. What is worrisome is the cost of servicing the debt service to revenue ratio, which has been very high. But of course, it's important to also recognize that in recent time, this debt service to revenue ratio, has begun to decline. At some point, it was as high as 90%, 85%. But the good news is that it has come down now to maybe under 70%. So however you look at it, it's still a source of worry. Even when you have a debt service to revenue ratio that is higher than 60%. What that means is that out of every $1 you earn, you spend as much as 60 cents, servicing your debt. So that is where we are. It's actually worrisome. And if you also look at the composition, external debt is around 48% of the total, domestic debt 52%, and the external component, much of it, a significant portion, has come from the the commercial source. So that is for me a source of worry, where you have a situation in which 38%, up to 38% of the external debt component is commercial. Commercial means, of course, the cost of servicing that will be high, and that's why you find that if you look at the external debt service component, the cost of servicing euro bonds is as high as 55% of the total, whereas your multilateral loans that you've taken, which is accounting for close to 50%, is costing you less to service. So we need to do something about the uptake of external loans, particularly from the international capital market, when it has to be commercial. Now, what I also have for the domestic components is the fact that a lot of it, again, is by nature of the FGM bonds, which I always argue, is discretionary. Rather, we should use more of infrastructure bonds when we are doing the borrowing. So I think this represents my initial thoughts on the recent release of the size of Nigeria's public debt.
So I'm thinking, like, what are the consequences of the debt crisis, of course, on Nigeria's fiscal room for social spending?
Oh yes, the consequences are obvious. First, of course, the opportunity cost is high. When I say opportunity cost, I mean the foregone benefits, what we could have also used the money for. You are spending so much servicing debt, whereas that money could have been used for, developmental purposes. Take 2025 budget, for example. We have budgeted as much as 14 trillion for debt service alone. The 2025 budget size is 55 trillion. The deficit in there is 13 trillion. But the cost of servicing the debt is as high as 14 trillion. Okay, you can imagine what 14 trillion, could do for this economy. And of course, the entire debt you're talking about is not domestic. If it were domestic, you could say, all right, even when you're servicing, the money is also circulating within the economy. But there's, of course, the external component that you must also, convert to dollars to be able to pay. And when you are servicing your debt stock using dollar, you know the effect of that it has on reserves. It is creating a hole on external reserves, because it's from external reserves that you use to service your external debt. And when external reserves, when you're depleting your external reserves that way, of course, the central bank is not in a strong position to defend the value of the naira. So that affects the liquidity in the forex market. That affects the exchange rate. So these are the consequences that you find. And of course, all of this, ultimately, when you have increasing debt, what happens? You also bring about, inflationary pressure. So it leads to inflation, and high exchange rate. And your guess is as good as mine as to the consequences of all that on the macroeconomy and even on the microeconomy.
We talked earlier that the federal government is considering a reset of, economic strategy, of course, to see how they implement this budget, considering the topsy-turvy we've had in global stocks and, of course, reacting from the U.S. President Donald Trump's 14% tax on Nigerian imports. I don't know how this really affects our own budget implementation now. How effective do you think the budget implementation of the federal government is to reducing this external debt?
Of course, it's going to affect the budget projections for 2025, the recent U.S. tariffs, sweeping tariffs. Yes, for Nigeria, it's mild in the sense that it's just 14% above the baseline of 10%. So in terms of direct impacts, people argue, given our trade volumes with the U.S. and the fact that not much of it, the bulk of it is oil, and oil is not facing these tariffs. So the items that are facing the tariffs are few. And to that extent, direct impact may not be much. But the broader implications are what the government should worry about. The indirect impact, if you choose to call it that. And that's talking about the fact that it could trigger global inflation. That's one. And when you have global inflation, what happens? We import so much from the rest of the world. That can also lead to inflation here in Nigeria. And what we're even beginning to see now, trade war, it's already, you can say it's already gone full-blown. China imposing as much as 84% tariffs on the U.S., and U.S. also retaliating by saying they're doing over 100%. Even with the pause, the 90-day reprieve that Trump has recently announced has also exempted China. So when you find these two major global powers, involved in trade war, of course it will affect the entire globe. When you begin to see trade slowing down, global trade slowing down, it can affect the crude oil price. And we're beginning to see that crude oil price, dropped from over 70%, over $70 per barrel. Today it's as low as $64 per barrel. And the 2025 budget is based on $75 per barrel. So you can see how it's already impacting the budget. So revenue projections will drop, including even the non-oil revenue projections, because number one, you're talking about exports that are going into US that will now be reduced. So export revenues will now drop, okay, because number one, you're making the goods we're exporting to US less competitive. So the companies that are doing that will pull back, and that will affect companies' income tax. It will affect the VAT revenue. It will affect export duties. So by the time you aggregate this, you realize that not only oil revenues will be affected, but also non-oil revenue. So that will impact the 2025 budget, quite negatively. So, and I'm sure the government realizes that, which is why the minister and coordinating minister for the economy talked about, measures that the government will be putting in place to address, this risk to the, budget implementation.
Well, let's go back a bit to the performance of the economy last week, where the CBN reported a positive in the increase of net forex reserves. And just yesterday, balance of payment surplus was also recorded. I just want to get your thoughts on that, and just to know if we're actually, on the right track to getting a bounce back in our economy.
Well, I think the economy is gradually improving. That's what the numbers say. Whether you're looking at the inflation rates, in February, you saw the number, 23, about 23%. So that's a moderation in the rate of inflation. Regardless of whether you're even looking at the old methodology or the rebase, the new methodology, the inflationary pressure is, gradually, reducing. You're also looking at GDP. The last GDP number we saw, okay, for Nigeria, above 3%. So again, that tells us that we are beginning to see improvements in output. The Purchasing Managers Index, which is also a measure of manufacturing activity, is also reading more than 50 points. And if it's more than 50 points, you will say there is expansion in manufacturing activity. So the numbers tend to say that things are improving. Although I must also admit that it is important so that it trickles down, that to what people might call realistic living standards of Nigerians. Although that may not happen immediately, in my view, because of the lag between these numbers and their impact on the economy. Now, you talked about the number released by the central bank. Yes, the BOP surplus, which we have not had for some time, of course, is a positive development. Even though the surplus is also coming, if you look at what central bank released critically, is coming principally because imports dropped. Trade surplus is simply you have your exports being more than your imports. So imports reduced on account of course, high exchange rates. So when your naira is devalued, or when your naira is depreciating by using market forces, of course that will impact imports. So when imports reduce, we are bound to have balance of trade surplus. But again, we should also recognize that that report also says both non-oil exports and oil exports improved. So we saw improvements in exports, and then we saw a decline in imports. That's what gave that result. I mean, in terms of the odd capital components, the financial components, we also saw increased capital inflows into Nigeria. Again, although much of it came by way of foreign portfolio investments, which a lot of people know or regard as hot money. They came in at foreign portfolio investment. And if you also read that report very critically, the report is even clear that foreign direct investments declined, which everybody agrees is the real thing. What this country needs is foreign direct investments, and not just foreign portfolio investments, because that simply tantamounts to, as I said earlier on, hot money. Foreign investors, foreign portfolio investors are known as fair weather friends. They only stay when the going is good. When there are shocks to the economy, they run, and then that can also destabilize the economy. So, in summary, yes, I would say that the economy is beginning to pick up. Okay, compared to, I emphasize, relative to the experience we had in 2024.
I think a lot of people, particularly me as well, of course, and I know you as well, would want to see that reflect in our pockets. I know that you said that yes, this indicator signal a recovery of Nigeria's economy. But when are we going to see that really trickle down to the common man on the street?
Yes, I want to be positive. I want to be bullish about it. That the moment the attention begins to shift to a lot more productive activity, I'm pretty sure that will begin to happen. Okay, you see, there's something about GDP. That's why I talked about the numbers looking good. But again, just as rightly mentioned, it has to reflect in people's pocket. GDP can be growing, and yet poverty will be, is rising. And that's when that GDP growth rate is not non-inclusive. That's when that GDP growth rate is only favoring a few. So when GDP trickles down, okay, that's when people begin to feel it. And for that to happen, we need to ramp up production. If you look at even the GDP growth rate, if you disaggregate the numbers, you would find that the agri sector and the manufacturing sector are not doing well. Okay, it is only the services sector that is powering the economy. All right, and to a large extent the oil sector. So the productive sectors really, or the real sectors, manufacturing and agriculture, are still in the doldrums. So we need to pull that, because remember, agri sector, you can see the number of people it employs, you can see the contribution to GDP. Agri contributes 25% to GDP. Manufacturing close to 10% to GDP. So these sectors need to be given attention. By the time you give attention to manufacturing, including through access to credit, particularly for firms, which is also why I want to recommend that one of the things the economic team should be thinking of now, in order to address this fallout of the U.S. Sweeping tariffs, is to come up with an intervention fund. Okay, something that these firms that are affected, whether they are in the cocoa industry, fertilizer, textiles, a fund that they can access at single digit at very low interest rate. So they need to access fund, they need to cushion the impact of what is happening, so that they don't also begin to lay off workers, and then you begin to have high unemployment and so on. So we need to boost production, and one way to boost production, as I said earlier on, is to intentionally ensure that SMEs, especially those in these sectors I mentioned, agro-allied industries, they benefit. When we take loans, because we are discussing public debt, we should properly apply them. The recent one we got from the World Bank, $500 million, dollar loan. The World Bank is saying we should use it to distribute to the vulnerable groups, which is something that I frown at. Okay, we shouldn't be borrowing money to distribute by way of cash transfer, conditional cash transfer. Yes. So we should borrow money to apply to productive uses. So imagine if we borrow that 500 million, for example, and we used it to, say, support the maybe agri sector, this SMEs in the agri sector, or we used it to do something that will also reduce people's out-of-pocket expenses, maybe in health even, expand the national health insurance scheme, or in education, ensure that people have more access to education. These are the kind of areas we should be applying loans to, and not just to borrow for the purpose of distributing to the so-called vulnerable. And the challenge with that, we don't even have the record, proper record of these vulnerable people. And when you give money to somebody, 25,000, 50,000, somebody, and it's one-off, you've only provided food for that person for a single day, okay? So what is more important is to give the person the hook to catch fish and not to give the person fish. So such loans should be channeled to skills acquisition, to skills development, so that people on their own can begin to fend for themselves. That is the way to grow an economy. And also that is the way where, we can ensure that some of these challenges are addressed.
Professor Uche Uwaleke, we'll put you on hold for a bit and then we'll get back with the discussion just right after this break. To stay with us.
In a world that's always evolving, one name has always been a constant: United Bank for Africa. 75 years of championing dreams, breaking barriers, and igniting change across the continent and beyond. From our roots in Lagos to the global stage, UBA is Africa's heartbeat, connecting cultures, empowering futures, and driving progress. We're more than just a bank. We are a partner in your journey, a supporter of your dreams, and a builder of a brighter tomorrow. Every interaction with UBA is a step towards a future where possibilities are limitless and dreams are realized. United Bank for Africa, where ambitions find a home, and together we shape a better world. United Bank for Africa. One brand, global influence. United Bank for Africa, Africa's global bank.
You're watching Business Nigeria. I am Sarah Yeku, and we have in our Abuja studio Director, Institute of Capital Market Studies in Nasarawa State University, KEFI, and President of the Capital Market Academics of Nigeria, Professor Uche Uwaleke. Thank you so much for staying through with us. Just before I let you go, I just want to get your projections for March's inflation rate. What do you think it will look like, considering what we've seen, the indicators we've seen in the last couple of months?
Yes, I think we are going to see a continuation of the disinflation that started in February. Disinflation is a situation in which, yes, inflation is rising, but it's rising at a slower pace, and that's going to be on the back of again the reforms the Central Bank of Nigeria has been implementing. I think in terms of the forex market, the central bank has done a lot to bring about transparency, and market discipline with their forex code, with their forex matching system. So once we have stability in that space, we also read the recent disclosure by the central bank of reserves, net reserves. External reserves, increasing by over $23 billion. So once we have a handle in that forex market, it will go a long way to feeding to the inflation number, because a lot of inflationary pressure we're having in this country is coming from the exchange rate angle. And the moment the central bank continues to, stabilize that market, we are going to be having the positive impact, on inflation. So I think inflation rate will continue to moderate. For March, I want to project something below 23% in furtherance of that disinflation trajectory.
All right, Professor Uche Uwaleke is the president of the Capital Market Academics of Nigeria and also the Director, Institute of Capital Market Studies in Nasarawa State University in KEFI. It's good to have you join us. Thank you so much for sharing your thoughts on the program. It's always a pleasure to have you.
Thank you.
Thank you.